Hi guys, this is Sam for Wealthwise by Sam Mall. Last time we discussed two different videos. The first one was what are the 5 sectors where you can do a sector rotation or where you can specialize and generate wealth for yourself and for your near and dear ones. The second video we talked about the 5 skills which are essentially required to generate a multi-million or multi-billion dollar business or consistently generate wealth for you. Today we are going to talk about how you can protect what you have. There's a saying that income is not guaranteed, but expense is. So it doesn't matter whether you earn or not, you will always have to cater to your expenses. So what is the first thing we can do? We can actually go out and save what we have. So there are two kinds of expenses. If you look at your paycheck, you will be doing primarily two major expenses. One is your mortgage, which is a huge expense. But what happens first before mortgage? You end up paying tax, TDS, tax deduction at source. So if you're making $10,000, you are going to pay $3,000 tax deduction at source on the average. And then you're going to pay $3,000 for mortgage. So total expense, we are talking about $6,000, right? So now you're left with around $4,000, out of which maybe $1,000 is spent in the conveyance, the car and the insurance for the car, and then you're left with $3,000 in which you're going to make ends meet. But most people don't even make $10,000 a month. On the average, I think American and Canadians make around $40,000 to $50,000 a year, which comes to $4,000 to $5,000 per month, right? So how can we first save what we have and then go out and earn extra income? So let's kind of decipher how do we save what we already have with ourselves, right? So what happens is, let me explain the concept to you out here. I know a lot of people talked about this. Robert Kiyosaki talked about it. A lot of gentlemen, a lot of so-called wealth creators talked about it. But I mean, some of it is the truth, right? So we can't help it. But I just want to tell you, everybody in the world should do it, because first you got to keep what you have, and then you got to go out and earn more, right? So what do you have? You have your paycheck. Every individual has a paycheck. Right? So let's look at it. So this is your income, right? So in the income, you have your TDS, tax deduction at source, right? Then you have your mortgage. So if I'm making $10,000, I'm going to pay $3,000 tax deduction at source. I'm going to pay average of $3,000 as my mortgage. My home carrying cost, which is insurance, other stuff like utilities, upkeep of home, would be another $500. Right? After that, you will need to travel, which is a major expense. So your conveyance, we are talking at least $1,000, even if you have a resale or refurbished vehicle, or you have basically second-hand vehicles, then you'll still end up paying maybe $700 as an EMI or a monthly installment, and you have $300 as insurance and gas. So there you go. So out of $10,000, I have 3 and 3, 6, 7, $7,500 is gone before it hits you, right? So what are you left with? $2,500, all right? So a lot of people will tell you, hey, you need to save 20% of your salary. Now, can you save $2,000 out of this $2,500 and still survive? My guess is most of you will say no, because this is not enough to pay for the kids' education. It's not enough for your travel. It's not enough for your entertainment. It's not enough for a family of 2 or 3 or 4. So what can we do? Is there a way to save one of these areas? So the single biggest thing which you never see that stands out is your tax deduction at source, right? So this is your TDS, right? So individuals get taxed at source, and a lot of so-called wealth creators have told you that, and they've told the truth, is if you want to save on the tax, you need to have a corporation. So we will create a corporation, and now I can have two things. I can have this corporation staying in parallel with my income, which is my salary, right? And still have expense in this corporation. Or I could take this money into the corporation, do an expense, and then I'm left with something on which I have to take a tax, right? So let's see. The first scenario here is I will take the money into a corporation as an invoice, right? I will do my expenses here. Okay, so let's say you have all of these as expenses, or typically out of you get $10,000, and I do my $7,500 expense for whatever reason, the corporation has expense, right? You're left with $2,500. Now go out and check what is the tax you're going to pay on $2,500 versus what you're going to pay on $10,000. So on $2,500, and I'm being very optimistic, you would basically pay around 10% tax, $250. So now I had paid $3,000. Now I have paid $250, right? So this is pivoting from an income which is directly paid to your salary to taking it to your corporation. However, there's a second, so that's method one. So this is one. The second method you could do is both this corporation, let's call it corporation C, and the individual is individual A. Both corporation C and individual A can coexist parallelly. They can kind of run together. So your home can be a home office and it can be a corporation as well. So you'll still have expenses. It will not be as optimized as this. But let's say if I do my expenses, same expense, I'm doing a 7,500, and actually you are actually left with only 7,000. So let's say your expense for the home office is, let's say, $4,000. Then you're left with how much was 7,000, which you made here. So $10,000 minus 3,000 is 7,000 that you got as your take-home salary. Now you had $4,000 in a corporation, which is your home office expense, and then you are able to you're able to get total of $3,000. Now the advantage of home office is some of it can be claimed as tax rebate, some of it can be claimed as different levels of expenses depending on what kind of side gig you are doing. So you will have a parallel corporation with your income and a company, and you'll still save a lot on tax. So however, the optimized method would be to take the money on the corporation, which is most of the self-employed or corporations or individuals who are professionals do that, doctors, lawyers, immigration consultants, so on and so forth. You could also do a parallel corporation, which will still save tax, not to the extent that the direct payment saves, but on the average, if you're paying $3,000, in the first case, we are paying $250, so we are saving $2,750. That's what we are saying. In the second thing, in the parallel corporation, I made an expense of $4,000. So I got $7,000, and then I have $2,500 left. My guess is because you have made an expense of $3,000, when you file your tax return, you will still get at least $1,000 back in method 2. So when method 1, I save $2,750, right? $2,750 in method 1. Method 2, I save $1,000, right? So now there you go. This is the money you had, but it was not coming to you. Now you've got $2,750 more extra money for yourself and $1,000 extra by having a parallel corporation or a side gig for yourself. Because when you file, you expense it out. There you go, guys. So in our first journey for building wealth, I have saved $2,750 out of $10,000. So that's 27.5% money saving. Of your overall expense, I would say it's 40% of your total expense is what we have saved. In the second case, we have saved $1,000, which is 10% of your overall income we have saved. But in terms of your expense, we have basically saved around 15%. So 40% if you do a pass-through through corporation and you invoice and expense it through the corporation. And in the second case, you have a parallel corporation. So when you file tax return, you get $1,000 back. So in either cases, 2750, 27.5% saving of your income. Second case, 10% of saving of your income. Now, this is the money we are going to use to generate our $1 million, right? So there you go. So now the corporations in Canada, you can have a corporation, or you can have a proprietary, or you can have a LLC or a LLP. In US, you can have a LLC, which is a pass-through entity. That means revenue, income, expense will come to you as an individual. You can have second kind of a company called S corporation. But for S corporation, you need to be an American citizen or an alien resident or a permanent resident of US. The third kind of corporation is called C corporation, where you are taxed as a company, and then even after you get money, it's not a pass-through entity, you will have to pay tax again, right? So there are three different corporations. In Canada, there are primarily two corporations, right? You can have a partnership company, or you can have a C corporation or a LLP. So primarily a small organization, which is the LLP, or you could have a corporation. In US, you can have three kinds of companies. You can have a LLC, you can have a S corporation, and you can also have a C corporation. Now, where do you form these companies? How do you file taxes? We're going to look at that, and there's lots of benefits there as well in our journey. But here, you guys, we start with this $2,750 a month, and we start with $1,000 a month, and we're going to multiply this to generate the first $1 million. I hope you like this concept of saving. You do not control your income or your revenue, but you can definitely control your expense. Because there's a saying, most people are poor because the way they spend, not by the way they earn. And it's not further from the truth. That's the truth. So please like and subscribe this channel, right? We'll continue our journey with next topics, and we will build on the money that we have saved here, and slowly venture to our journey for being the first $1 million. Now, I'm doing this not as an advice. It's not a suggestion or advice. You're free to do what you like. All right. It's not a guidance. It's just a case study that I do, or I would implement for myself if it was me. It's totally up to you what decisions you take. So there's a clean disclaimer out here. Plus, please do like and subscribe the channel and share this, and we will together generate more wealth. This is Sam signing off for Wealthwise.